Over the past 6 years that I've been trading, I've watched countless traders, some even making $100,000, blow up their accounts within weeks. Even one that made almost 100 million and lost it all. We discussed this on a podcast on this YouTube channel, Systematic Shenanigans, about James Wynn. You can look and verify this on chain in crypto. He was chasing $100 million. He went on an incredible lucky streak, and then he ultimately blew up because he was taking excessive risk. Now, one wrong decision, one emotional override, one moment of doubt, and years of progress can evaporate, as it did for James Wynn. I've made every mistake in the book over the past 6 years. I've turned off profitable strategies during drawdowns. I've over-optimized backtests into oblivion. I've blown through months of gains in a single week of poor decisions. So I wanted to take a moment to share the lessons that have cost me tens of thousands of dollars so you don't have to learn them the expensive way. Now, to give you a bit more information about me before we go into the first lesson, I'm an algorithmic trader for the most part. So I run 10 plus algos, mainly on futures and crypto. And last month I did 18%. You can look over my performance recap, I think in the previous video, but here's also the equity curve over that past month. But let's get into the first lesson. First one is testing until you find gold. If you run 50 different parameter combinations on the same historical data, and then finally one shows you 75% win rate, a smooth equity curve, you're probably thinking you found gold. You get ready to deploy it live, and then it fails within the first couple of weeks. What actually happened here? Well, you tortured the data until it confessed. You found noise and not an actual genuine edge. Every time you test a parameter, you're spending your historical data. By the 50th test, you're overfit to randomness. Now, how do you actually fix this in your backtesting? You'll want to limit optimization runs. So if a strategy doesn't show you promise initially, move on. At least for me, what I like to do is if a strategy doesn't at least look somewhat decent on the first backtest run, I'm not going to really be changing too much of it. It does depend on where you're coming in from that strategy. For example, if you're starting that strategy from an idea that's already presented online and you're just testing that idea, if you test that idea and it doesn't show promise, then I'll probably just move on. If I'm creating a strategy from scratch, just from the idea of strategy types, then maybe I'll add 1 to 2 iterations max, but I'm not, running 100 optimizations just to find the best parameter values. And then 2, you want to use out of sample data that you have never touched during your development. There's 2 ways of doing this. You can do the traditional in-sample and out-of-sample data. So this is where you have in-sample data where you're going to be testing over, you're going to be optimizing over. So this could be a 1-year period, 2-year period, etc. And then you'll have 1 to 2 years of out-of-sample data where you can test those parameter values that you found in sample on the out-of-sample data and see if it has done as well in the out-of-sample. Additionally, there's another method called walk-forward optimization. I have a video about that on this channel, I'm pretty sure, and that's the primary technique I use in futures. Now, the best strategies work because the logic is sound, not because you found some magic parameter combination. And this has been true for pretty much all of my strategies that I'm running in futures. 2, focusing on perfection instead of portfolio. I've seen traders waste months, even years, trying to perfect one strategy, adding parameters, running endless optimizations, chasing the perfect equity curve. I did even meet a trader that had been testing one strategy in simulation for over kind of 2 years, and he had never deployed it live because he was constantly testing it live and then kind of tweaking it based on backtests as well, and then kind of redoing it live for simulation and then kind of going back and forth. And that was over a 2-year period. And ultimately, what successful systematic traders are doing is they're building a portfolio of good enough strategies that compound into great results. Here's the ultimate truth. Your first strategy does not need to be 100% annual return. What it really needs to be is statistically valid. So you want at least 100 plus trades. Like ideally what I'm looking for is normally 300, 500, even 1,000 trades if possible. And you want it to be properly validated. So whether that be doing out of sample testing, Monte Carlo simulations, parameter sensitivity, and a lot of these other tests I've kind of mentioned on this channel through different videos. Ideally, what you want to be leading to is building a portfolio of 5 or more strategies. I would say the sweet spot is around 5 for most portfolios, but obviously you can add more from there. I've been stuck at around 10 strategies for quite a while because, to be honest, once you get to around 10, at least from my experience, every strategy you create after that kind of already is very correlated to another strategy. So it's very hard to get strategies that are at least low correlation to each other. But I have seen some traders have way more strategies than me and have been super successful. And the reason for this, of why we're building a portfolio, is because when strategy A is in a drawdown and strategy B is printing, they can kind of equal each other's out. And for example, when the market regime maybe shifts and kills strategy C, strategy D and E can kind of keep you afloat. So in part, it's kind of like a balancing act, right? You're trying to maintain a very stable equity curve. And by doing so, you're kind of canceling out different strategies that are maybe going to drawdown. And then they're going to obviously have a bit of an extra return during that market regime. Now, the fix here, instead of focusing on perfection, is try and set time limit on strategy development. I know it sounds super simple. Obviously, it will depend on how long you'll need based on your own skills and whether that be coding, backtesting, etc. But try and set a reasonable time limit and say, well, if I've dedicated this much time for this particular idea and nothing really seems to work, doesn't really show me promise, just move on. A lot of the time, you have to go through a lot of ideas to find something that actually works, or you're maybe approaching the ideas incorrectly. For example, nowadays I don't have as many ideas that fail, but that's mainly because I've tested hundreds and hundreds of strategies, and two, I really understand strategy types and what kind of builds a good trend following, what builds a good mean reversion strategy, etc. If you can't validate it in X time, then just move on. Your goal here isn't perfection. It's building a robust portfolio that survives different market conditions. There really isn't one strategy that is going to fix everything, that's going to not have a drawdown, that's going to work on every market, every time frame. I've never found it. Maybe you will, but to be honest, at least from my 6 years of experience, I don't see that, ever really existing. One way also can be setting every strategy that shows you any promise at all to at least deploy on a sim account or a very small amount of capital. Personally, I prefer deploying it on a really small amount of capital because then at least I have some skin in the game. But it's a good way to not get fixated on this perfection idea, because you never know. I've had some strategies that have looked okay in backtest, but then a market regimes come around and they've performed super well during that market regime. And even though that they were a very small, part of a portfolio, they did actually add some decent returns to it. So I would always say it's worth, if it shows you any promise, just put on a really small amount of capital. Obviously, that would depend on based on your portfolio size, but normally for me, it's sub, 2%, give or take. Now, number 3 is recency bias, changing everything after one bad week. You have a strategy that's been profitable for 2 months, let's say. Then you hit a rough period. You have 5 losses in a row. Panic maybe sets in. I'm needing to change my entries because it's always, getting hurt because it's entering too late, for example. You tweak the strategy, the losses then continue, then you tweak again, and then within a month, you've probably destroyed a perfectly good system. The reality is every strategy will have losing streaks, and if you backtest this properly, you'll actually know that this is coming and it's a realistic expectation. For example, a trend following strategies that I run, there will be periods where maybe they won't be working for at least 1, maybe 2 months. Depends on how trending the market has been. Over the past, I'd say a couple of months has been really good, but there definitely has been periods in history where you can have a trend following system not work for a year. And it's something you have to be able to understand. And that's why it's also a benefit to have multiple strategies running. And even if you have a super high win rate strategy, let's say you have an 80% win rate strategy, there will still be weeks where you go 2-8 or even more, because you can have more consecutive losses than you would maybe expect. The solution for this is, before deploying any strategy, run a Monte Carlo simulation so you can get an idea of the worst case scenario. Now, I will say in trend following, if you run a Monte Carlo simulation, the scenarios will look a lot worse than maybe that is expected. The reason for this is trend following strategies obviously rely sort of on outliers, because outliers are a huge part of them keeping up returns, because they're normally taking very small losses and then one trade will pay 10xr, for example. So when you reorder those trades, especially if you're doing resampling or resequencing, it can get some really nasty equity curves. So just keep that in mind. It is still good to test to get an idea of what could worst case scenarios be, but I'd also really small thing is just testing your strategy over a stress period. So test it over 2020, test it over 2008, test it during the tariffs, see what would have happened there and how badly you would have been affected during those times. And then when you're in drawdown, try and compare it to those times, whether that be your Monte Carlo results or, the stress test, for example. The last thing you want is to change a system because of one bad week of losses. We went through it in a recent podcast, but one of the biggest life lessons I've had from trading is that the best traders know how to deal and sit through pain while making logical decisions. And there's nothing really else to it. If you have a losing week, there is nothing you can do to get out of that losing week instantly. And it feels like you should be doing something right because you're losing, but it's just the way of the probabilities of that strategy. Now, the bottom line here is 6 years in, I've learned that systematic trading isn't about finding the holy grail strategy. It's about having objective rules for hard decisions, building diversified portfolios over perfect systems, and constantly evolving before you're forced to. I hope this helps.